To chapter 3 of the Financial Economic Survey, Fiscal Development, Revenue Relish. With the continuing global risk and uncertainties, the availability of fiscal space with the government has become paramount. It is especially true following the recent incidents of pandemic when the fiscal policy became an effective macroeconomic stabilization tool globally. The large front loaded packages across the countries led to the overstimulation of demand, leading to its much faster recovery. In combination with the still existing supply disruptions and constraints, the overheating of the economy led to inflationary pressure. The conflict in Europe and related geopolitical developments aggravated this crisis. The slowing global growth, rising interest rates, persistently high inflation rates, and uncertain global environment have thus posed certain pertinent questions for fiscal policy experts to motivate the overarching fiscal policy strategy. Developments in the union government finances. The fiscal deficit reduced to 6.7% in FY22 from 9.2% in FY21. But government is well on track to achieve the budget estimates for fiscal deficit in FY23. This resilience has been due to recovery in economic activity, buoyancy in revenues observed during the year, and conservative assumptions of macroeconomic variables in the budget. Reasons for sustained revenue buoyancy: rebound in the collection of all major direct and indirect taxes. This gradual decline in union government's fiscal deficit as a percentage of GDP, in line with the fiscal glide path envisioned by the government, is a result of careful fiscal management supported by buoyant revenue collection over the last 2 years. Tax revenue: despite tax rationalizations, a positive trend of higher tax buoyancy is visible in the economy. Regarding direct taxes, higher growth due to rising corporate and personal income tax growth, custom and excise duty trends. Indirect taxes such as customs and excise duty have acted as a flexible policy tool during fiscal response to the pandemic. Example: low global oil prices created some elbow room for raising excise duty on petrol and diesel to augment the revenue pool. Given the rise in prices of essential imports, custom duties were brought down on several items to control inflation, but still the custom collection grew at 12.4% year on year due to high imports. Stabilizing goods and services tax yielding return, the GST collection has hit an average monthly collection of 1.5 lakh crore between April and December 2022. Reasons were rapid economic recovery post-pandemic, the nationwide drive against GST evaders and fake bills, GST Council's rate rationalization measures to correct inverted duty structures. GST-related trends: number of GST taxpayers increased from nearly 70 lakh in 2070 to more than 1.4 crore in 2022. Now, when we see the tax profile of the union government, we see that CIT, that is Central Corporate Income Tax, forms the second highest chunk. GST forms the highest chunk at 28%. Personal income tax forms 26%. Combining CIT and PIT, we get 52%, which means direct taxes are forming 52% of the total revenue from taxes. Now we see direct taxes in terms of growth in centers. Direct taxes are higher than their corresponding long-term averages during the period of April to November. This is the figure representing all the direct taxes. Gross tax. Moving on, non-tax revenue committed during disinvestment but dependent on external factors. During FY15 to FY23, as of 18th of January 2023, an amount of about 4.07 lakh crore have been realized as proceeds from disinvestment through 154 transactions from various modes and instruments. Performance of the union government expenditure. In FY21, the government adopted a pragmatic approach of increasing its expenditure in a calibrated way. Basic safety nets for the vulnerable, plus productive domestic capital expenditure, which was the Babel strategy. That is agile fiscal strategy on one side and providing safety nets for the vulnerables on the other side. Last few years have been underlined have underlined the importance of counter-cyclical fiscal policy measures to support the economy during a crisis. The pandemic mandated additional expenditure requirements during FY21. In FY22, total government expenditure was brought down to 16% of the GDP with increased capital expenditure. CapEx led growth to bring back animal spirit and manage debt levels. Government has budgeted 7.5 lakh crore of capital expenditure for FY23. Significance of capex: while on one hand, capital expenditure strengthened aggregate demand and crowding of private spending in terms of risk aversion, it also enhances the long-term supply side productive capacity. Incentives by center to boost states capex, long-term investment, interest-free loans, and capex-linked additional borrowing provisions. Geopolitical developments stretched the revenue expenditure requirement. Revenue expenditure of the Union government was brought down from 15.6% of the GDP in pandemic year FY21 to 13.5% of the GDP in FY22. This was done by reducing subsidy expenditure from 3.6% of the GDP in FY21 to 1.9% of the GDP in FY22. Major sources of expenditure: pandemic led high food and fertilizer subsidy, interest payment, but in the medium term, buoyancy in revenues, aggressive asset monetization, efficiency gains, and privatization would help play down the public debt, thus bringing down interest payments. Overview of the state government finances. State government improved their finances in FY22 after being adversely impacted by the pandemic in 2021. Supporting the GST compensation payments during the crisis, cess payments, and tax devolution installments to states were front loaded to give them early access to funds. Enhanced limit of borrowings for the states and incentive for reforms. Since pandemic, the center has kept the net borrowing ceiling of the state government above the fiscal responsibility legislation threshold. It was fixed at 5% of the gross state domestic product in FY21, 4% of the gross state domestic product in FY22, and 3.5% of the gross state domestic product in FY23. The Union government has provided 50-year interest-free loans to state governments under the scheme for special assistance to states for capital investment for the last 3 years. Now we see the consolidation of state deficits as percentage of GDP. The percentage of the state deficit stood in the budget estimates of 2023 at 3.4%. It was 2.8% in FY22 and it was 4.1% in FY21. Lower state combined fiscal deficit during April November. We see that in the budget estimates, we have marked approximately 8.19 lakh crore rupees for the combined fiscal deficit, states combined fiscal deficit, and in the FY22-23 we have marked approximately 8.83 lakh crore for the combined fiscal deficit. Now, debt profile of the government. IMF projects the global government debt at 91% of the GDP in 2022, about 7.5 percentage points above the pre-pandemic levels. Post-pandemic, total liabilities of the Union government moderated from 59.2% of the GDP in FY21 to 56.7% in FY22. India's public debt profile is relatively stable and characterized by low currency and interest rate risks. We see the major proportion of the liability of public debt is in internal liabilities and 4.9% is external liabilities. Indirect tax measures by CBIC during 2021-22. Ease of compliance on taxpayers. New scheme of updated return facilitates the taxpayers to voluntarily update his return anytime within 2 years from the end of the relevant assessment year by paying additional tax. Pre-filed income tax returns has been further expanded by including information such as house property income, capital gains from securities, bank interest and dividends. New provisions under the Income Tax Act, successor entity to file a modified return within 6 months. Procedure for assessment, appeal, and levy of penalty under the Income Tax Act have been made faceless by eliminating the human interface between the assessing officer. Reduction in litigation, dispute resolution committee. A taxpayer having taxable income up to 50 lakh rupees and disputed income up to 10 lakh rupees shall be eligible to approach the committee. Measures undertaken to curb tax evasion and facilitate the widening of tax base, annual information statement, and e-verification scheme have recently been enabled. The Finance Act of 2022, taxation and virtual digital assets, where the transfer of which virtual digital asset is to be taxed at the rate of 30% plus a TDS of 1% of the transaction value. Deduction of tax at source, TDS of 10% of the value of benefit or prerequisite in terms of business or profession. That'll be it for this chapter.